Markets have been soaring. It's good to see some green finally after what has been a very difficult 2022. Of course, investors are now asking themselves, is the market crash finally over? Or is this still only just beginning and is there worse up ahead? Today we're going to discuss 4 key factors to consider as a framework to think about, where we try to understand where things may head from here moving forward. Before we discuss that, of course, the hair. Yes, we've gone for a bit of a change. It's been a while, we're back with the videos, it's great to be back into the new chapter. And of course, on the channel, we've gone through many of the different phases. We had the afro, everyone wanted to bring that back, but I thought we'd go a different way. We had the shaved head, and here we are. Socceroos have just made the World Cup, thought we'd get behind the cause. Of course, Christmas is just up ahead. And honestly, at the end of the day, I think life's too short not to live it with a smile, to have a bit of fun along the way. Of course, hair will grow back, but I'd love to know your thoughts. I know you're all eager for it, so drop in a comment and let us know what you think about it all. But now, let's talk about the markets after what's been a very fascinating past few weeks. So factor number 1 for us to consider is sentiment, and the fact that sentiment can move markets. Now, this was most evidenced last week, where we saw the US CPI inflation print. It was hotly anticipated, eagerly awaited, and of course, the consensus was 7.9%, coming down from 8.2% the month prior. But we saw 7.7%. It was softer on the inflation front. And of course, the markets went flying. One of the best one days recorded in a single session. S&P 500 up by 5%. The Nasdaq up by over 7% in a single day. And of course, this flowed through to markets around the world. But as we know, sentiment, individual pieces of news can send markets plunging down on a day, or like we saw, they can shoot higher. But we have to understand the fact that sentiment can move the markets in the short term, but it's fundamentals that drive the trends and the trajectory over the longer term. It is a fool's game to try to guess where things are going to go on the day-to-day. Short-term price movements, of course, are a factor of so many different factors and inputs that contribute into it. But it's worth noting that sentiment can and does move markets in the short term. The second factor to consider when thinking about where we're currently positioned is valuations. Valuations, of course, are a useful tool to help to compare. It can be used across a range of different factors, but it's worth noting that there's significant variance across a range of different areas, whether it's individual sectors, whether it's regions, whether it's points in time, or of course, stages of the cycle that we may be in. Valuations are never a perfect one-for-one comparison, so we have to understand that when we're looking into it. But of course, they can give us a bit of an insight into where we may be positioned in comparison to perhaps a previous time period. As we know, valuations were at record high levels during 2021, particularly as we saw exuberance coming into the markets. Of course, as interest rates started rising and the discount rates started going up, we saw valuations come down. They're at much more reasonable levels on comparison to long-run averages, but of course, there still potentially could be longer to fall in comparison to some of the other most depressed valuations that we've seen in history. But many investors now are trying to work out, have valuations fallen far enough? And if so, where will the floor be at the bottom of this valuation downturn? The third thing for us to consider when we're thinking about it is the fundamentals themselves. And of course, the macroeconomic context has been so important when understanding where markets are moving, particularly over the past couple of years. As we saw over this past period, there's been the inflation narrative. Of course, there's been the interest rate discussion. Then on the back end of that has been what happens if rates move too fast, too quickly? Do we risk as we hit the brakes too quickly going into a downturn period where we see unemployment rising? Perhaps demand and output will go down, consumer demand starts to fall. Perhaps we send ourselves into the recession. Of course, there's a lot of questions, still a lot of them are unresolved, but the macroeconomic context is very important. We saw what happened earlier this year with the Ukrainian situation. Commodity prices started soaring after the supply chain bottlenecks. But of course, the context is always important to understand the longer term trends and trajectories about where the economy will be. Now, the economy is not the market is not the economy, but of course there's correlation and of course there is interplay between them. So it's always important to understand, yes, what's happening on a company-specific level, on a market-specific level, but also what is happening in that macroeconomic backdrop. And then the fourth important factor to consider is the risk of really a systemic shock or systemic failure. I'm sure many of you would have heard the discussion, are we in a 2008-esque type scenario? Is this the GFC 2.0? But there is a big difference between cyclical downturns, cyclical trends, markets move up and down, the economy moves up and down. That's a normal part of the mechanisms of the market, that things aren't going to stay stable and consistent all the time. Things go in cycles. But the question is now, is this just a cyclical trend? Or are we at risk of a bigger systemic shock? And a systemic shock must be delineated from just the traditional ups and downs of the market. Of course, this is not to say that we're heading into a GFC 2.0 situation. Some of the most bearish calls have stated that yes, perhaps a systemic shock is up ahead in mid-2023 and beyond as we start to see some of those concerns flowing through. We've seen some discussions about the housing market, the automobile market. Of course, we talked about unemployment, we talked about the demand outputs. Or is this more just a standard trajectory? Perhaps we're getting near a bottom now, and maybe there may be greener days ahead. Now, of course, it's important to remember that nobody has the answers. We're in such an uncertain period at the moment. There's a famous quote that says, all models are wrong, but some models are useful. You only have to look at something like the range of forecasts for year-end S&P 500 targets. We're already right near the end of the year, heading into November. But as we can see, there's still such a dispersion in terms of where the experts and analysts think we might end up. That's obviously a function of the inputs that go into models, but it's also worth noting that models use inputs based at a certain point of time. Of course, situations evolve, inputs change, and the markets continue to evolve and develop. So what's important is that we continue to take in a range of information, we develop our own worldviews and market views, and this will allow us to become more comfortable and flexible with the range of outcomes that may evolve. And if 2022 has taught us anything, it's that we should be ready and willing to accept anything out there. If you enjoy these types of discussions, we've done a range of videos recently on the channel. You can check them out up above. I'd love to know your thoughts, so drop in a comment below. Do you think this is just the beginning of the downturn? Or do you think we're nearing a bottom and perhaps there's greener days ahead? We've also jumped onto Instagram, got a new page. It's at ASX Investor IG. It'll be a great way for us to connect, so come and say hello and give us a follow. A big thank you for joining us. For now, stay well and happy investing.